Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down exactly how taxes work in Canada. I'll go over the basics of tax brackets, and I'll compare taxes for personal income, business income, and investment income. I'll also go over some ways to reduce your taxes legally, such as deductions, credits, and registered accounts like the TFSA and RRSP. Let's start with the basics. In Canada, you have to pay two forms of income taxes: federal and provincial taxes. Federal tax is common for all Canadians, but provincial tax differs depending on which province you live in. If you make $50,000 a year in Ontario, you'll pay the exact same federal tax as someone who makes $50,000 a year in Alberta, but your provincial tax rates will differ, and so your total income tax will differ. For both federal and provincial taxes, we have a progressive tax system. That means that as your income grows, the tax rate that you pay on this new income grows higher as well. This is done using tax brackets. You can think of tax brackets as buckets of income. If your income falls into a particular bucket, you will pay the same tax rate or percentage as any income in that tax bracket. Let's look at the second lowest federal tax bracket for income between $47,000 and $95,000. If your taxable income falls in this range, you're in this bucket, and so you'll pay the same 20.5% of federal taxes for each additional dollar of income. If you make $50,000 or $90,000, you're still in the same bucket, and so every extra dollar you earn will be taxed at 20.5%. This 20.5% is your marginal tax rate, and this is the most important number that we care about. If our income gets bumped up to $100,000, we don't fit in this bucket anymore, and so we jump up to a higher tax bracket. Now, we're in the tax bracket of incomes between $95,000 and $147,000, and our marginal tax rate has increased to 26%. This is a very important point. We don't pay 26% of our total income in taxes. We just pay 26% on the amount in this bucket. In this case, that's only $5,000, the amount above the $95,000 limit for the previous tax bracket. You are always better off earning a higher income. Even if you get bumped up to a higher tax bracket, sure, you'll be paying more money in taxes on this new income, but your total net income will still increase, and that means more money in your wallet. This is a big source of confusion, so let's highlight this with an example. We're only going to look at the federal tax brackets, but the provincial tax brackets work the exact same way, just with different numbers. These are the federal tax brackets for 2019, so you'll be using these numbers when you file your taxes in April of 2020. Let's say your income is $90,000 a year, so we start by completely filling up the first tax bracket of $47,630. The tax rate for this bracket is 15%, so we'll be paying $7,145 in taxes on our first $47,000 of income. The remainder of our income goes into the second tax bracket, but we don't quite fill it up since our income is less than the $95,000 limit. We have $90,000 minus $47,630, giving us $42,370. The tax rate for the second bracket is 20.5%, so we'll be paying $8,686 on our remaining $42,000. This gives us a total federal tax amount of $15,831 and a net income of $74,169. This is what we keep. If we divide our tax paid by our income of $90,000, we get an average tax rate of 17.6%. The average tax rate isn't really an important number. It just gives you a sense of how much of your total income was lost in taxes. The really important number is your marginal tax rate, which is the tax rate of your current tax bracket. In this case, our marginal tax rate is 20.5%, meaning that for every extra dollar we earn, we lose 20.5 cents in taxes to the Canadian government until we max out this tax bracket, and then our marginal tax rate will jump up. Let's say we earn an extra $10,000, and so our income is now $100,000. As before, we start by completely filling up the first tax bracket. So we pay the same $7,145 in taxes for our first $47,000 of income. But now, we completely fill up the second tax bracket as well. This tax bracket is filled with $47,629, which is taxed at 20.5%. So we'll be paying $9,764 in this bracket. But we still have more income left over. We've handled our first two tax brackets. That's $95,259. But we still have $4,741 remaining. So this money goes into the third tax bracket, which will be taxed at a rate of 26%. So we will pay $1,233 in this tax bracket. This gives us a total federal tax amount of $18,142 and a net income of $81,858 and an average tax rate of 18.1%. So even though we were bumped into a higher tax bracket, our total net income still increased. However, we did lose a larger percentage of our income in taxes. Our salary increased by $10,000, but our net income only increased by $7,700. You can see that with just a $10K increase in salary, our marginal tax rate has jumped up to 26%. This means that for every additional dollar I earn, I will lose 26 cents to the federal government. And that's just federal taxes. If you add in provincial taxes, your marginal tax rate will be between 36% and 45%, depending on your province. The tax brackets for each province don't line up exactly with the federal tax brackets, so it can be pretty tricky to calculate your provincial and federal taxes by hand. The most important number we care about is our marginal tax rate, including both federal and provincial taxes. The easiest way to find this marginal tax rate is to use an online tax calculator. The one that I like is the EY tax calculator that you can see here, and I'll include a link below. So you enter your income here, let's say $100,000, and we scroll down to the province we live in. Let's say we live in a province with a heavy tax rate, like Quebec. We see here the total taxes we'll pay, the net income, the average tax rate, and the marginal tax rate. The total tax amount here includes the federal and provincial tax. And an important point is that this calculator includes the basic personal tax credit, which I'll talk about later in this video. This tax credit reduces everybody's taxable income in the calculation, so it lowers everybody's federal tax amount. I didn't include this tax credit in our earlier calculations to make it simpler, but it is important, so use this online tax calculator when you're doing your calculations to get the most accurate amounts. Another great thing about this tax calculator is that it gives you the marginal tax rate on regular income, but it also provides you the marginal tax rate on investment income through capital gains and through dividends. And you can see that investment income is taxed significantly lower than regular income, which is why investing is such a powerful tool to become wealthy. I'll be breaking down exactly how investments are taxed in Canada in an upcoming video, so stay tuned for that. So if you live in Quebec and you have a high income of $100,000, the government will take 45 cents out of every additional dollar you earn. That's why it's important not to rely solely on your full-time job for income. Full-time employment is taxed heavier than any other kind of income in Canada, but unfortunately, the majority of Canadians rely 100% on their full-time job. If your salary is $100,000 and you get a $10,000 salary increase, I know it's really exciting, but as soon as you get that first paycheck, you'll see that the government is taking almost half of that salary increase away in taxes. Business income and investment income is taxed far less than full-time employment income. So instead of trying to get that $10,000 promotion and losing about half that money in taxes, you could have made a side business earning you $10,000 of business income, and you would only be paying around 30% in taxes, or even less, depending on your business expenses. You might even be able to avoid paying taxes entirely, the way a business like Amazon does. Plus, if you had invested your money and your investments earned you $10,000 in income, you would only be taxed around 25% of this investment income through capital gains and dividends. And you could avoid paying taxes entirely on this investment income by using a tax-sheltered account like a TFSA or an RRSP. Remember, in my video on the 4 steps to become wealthy, I emphasize that it's not about how much money you make, it's about how much money you keep. Too many smart people out there are focused solely on getting that high-paying job. They put all their time and effort into becoming a doctor, a lawyer, an engineer, and yes, they have huge salaries, over $100,000, but they are losing almost half of their paycheck in taxes, when instead they could have opened a side business or focused on investment income. You don't need a huge salary to become wealthy. You just need to be smart about money. And a big part of that is reducing your taxes, legally of course. Business income and investment income are already more tax efficient, and there are lots of ways to further reduce your taxes on these income streams. But with full-time employment income, there isn't a whole lot you can do. You'll be stuck paying that high marginal tax rate. The only thing you can do is reduce your full-time job's taxable income through tax credits and tax deductions. A tax credit reduces the tax amount that you owe, usually by a fixed amount, whereas a tax deduction reduces your taxable income, and so it reduces the tax amount you owe based on your marginal tax rate. Tax credits usually benefit everyone equally regardless of their income, as long as they're eligible, whereas a tax deduction offers more benefit for higher incomes. Tax credits can be either refundable or non-refundable. A non-refundable tax credit can reduce your tax amount to zero, but it will stop there. A refundable tax credit can reduce your tax amount to zero, and whatever money is left in the credit will be given to you in cash. So if you owed $1,000 in taxes and you had a non-refundable tax credit of $1,500, your tax owing would be reduced to zero, but you lose the benefit of the remaining $500 of tax credits. So you won't have to pay any taxes, but you won't be getting a check from the government. If you had a refundable tax credit of $1,500, your tax owing would be reduced to zero, and the remaining $500 in this tax credit would be paid out to you in cash. A lot of tax credits are only eligible for low-income earners and students, but there are a lot of tax credits which are available for everyone, like the personal tax credit I mentioned earlier. Some other tax credits include tuition credits, donations, medical expenses, interest on student loans, the GST, HST tax credit, and the first-time homebuyer tax credit. A tax deduction reduces your taxable income, and so the tax savings you get depends on your marginal tax rate. The higher income you have, the higher your marginal tax rate, and so the more you'll save in taxes by using tax deductions. If you earn $40,000 a year in Ontario, your marginal tax rate is 20.05%. If you have a $5,000 tax reduction, say you contributed $5,000 to your RRSP, you can reduce your taxable income by $5,000. You won't be taxed on this $5,000 amount, and so you'll save 20.05% of this, saving you $1,025. If you earn $85,000 a year in Ontario, your marginal tax rate is higher at 31.48%. If you have a $5,000 deduction, you'll save 31.48% of this $5,000 amount, and so you'll save $1,574. That's $500 more than you saved at a lower income for the same $5,000 deduction. This is why a lot of people hold off on claiming deductions like their RRSP contributions until they reach a higher salary. The higher your income, the more savings your deduction provides. The most common deduction available to all Canadians is the RRSP. This is one of the most important investment vehicles to generate wealth, and I'll be making an entire video on RRSPs very soon. But at a high level, an RRSP is a tax-deferred account meant to help Canadians build their retirement fund. All of your investments inside an RRSP grow tax-free, just like a TFSA, so it's incredibly useful to hold dividend stocks, REITs, and bonds in your RRSP, especially US and foreign equities. The second benefit is that an RRSP defers your taxes until the day when you withdraw the money out of the RRSP. This is usually when you retire, when your income is very low, and you'll be paying far less in taxes. Basically, an RRSP is a deal you make with the government. You're saying, I don't want to pay a large tax amount now. I'll delay these taxes by 30 years, and I'll pay a much smaller tax amount when I retire. RRSPs are the most common and powerful deductions that are available for all Canadians. But some other deductions include employer pension plan contributions, childcare expenses, disability expenses, legal fees, and moving expenses if your job required you to relocate. Remember how I said that business income is taxed more favorably than full-time employment income? That's because as a business, you can make way more deductions than a regular individual can. Most operating business expenses can be deducted from your taxable income. That basically means anytime you need to spend money in order to run your business, you can claim it as a business expense and deduct it from your taxable income, so you'll pay way less in taxes. I'll be making a whole series of videos on starting a business and how to claim business expenses. But some of the common expenses that I have claimed in my side businesses include fuel costs, rent, mortgage interest, car insurance, legal fees, phone bill, and parking. You'll notice that a lot of these expenses are things that everybody spends money on, like the phone bill or gasoline. The sad part is, even though everybody has these expenses necessary to live and perform their full-time job, these expenses don't offer any benefit at all if your only income stream is your full-time job. All of these expenses are just money down the drain for you. But if you have a side business, you can claim that all of these expenses are necessary for your business to operate. And so, you'll be able to save thousands of dollars in taxes every year. Let's imagine my business income is $100,000 a year. Normally, I would be paying around $25,000 in taxes as a full-time employee. But if my annual business expenses are $30,000, I can deduct this from my taxable income. And so, I'll be taxed as if I only made $70,000 a year, even though I actually made $100,000 a year. So the taxes that I actually pay will only be about $14,000. That's about half the amount of tax I would be paying for the same income in a full-time job. There are tons of benefits of owning a side business, not just taxes, and I'll be covering everything you need to know about running a side business in my upcoming videos, so stay tuned for that. So there you have it. That's how taxes work in Canada. Increasing your income is always a good thing, even if it bumps you up to a higher tax bracket. But don't focus all of your effort on full-time income. Income from a side business and investments are taxed far more favorably. And don't forget to take advantage of tax deductions and tax credits. I'll be making a whole series of videos on Canadian taxes, including how investments are taxed through dividends and capital gains, and how to use a TFSA, an RRSP, and an RESP. So stay tuned for those videos. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really helps me build this channel, and hit that bell icon to be notified of my new videos every week. Be sure to tune into my next video, where I'll be breaking down my favorite Canadian ETFs to invest in for dividends. Thanks, everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye, guys.